Hello everyone, my name is Shaitali Rathod, roll number MB22114. Today I am here to present my presentation and my subject is derivatives and risk management. My topic name is commodity derivatives. Commodity derivatives are a financial instruments whose value is derived from the price movement of underlying physical commodities such as agriculture product, energy resources, metal, and other raw materials. These derivatives are traded on a commodity exchange and serve a various purpose for a market. Participants include the hedging against the price fluctuations, a speculation or a future price movement, and portfolio and diversification. Here are some key aspects of the commodity. Types of commodity derivatives. There are three types of commodity derivatives. First is the future contracts. The future contracts are similar to a forward a contracts. Future contracts mean an agreement made by the two parties to buy or sell underlying instruments at a fixed price on a future date. A future contract do not allow to buy or and sell to meet and enter into an agreement. In fact, the deal gets a fix through exchange mode. In future contract, the counterparty risk is a low because it's a standardized contract. In addition, the clearinghouse play the role of counterparty to the parties of contract, which reduce the credit risk in the future. The size of a future contract is fixed and it's regulated by the stock exchange just because it is known as a standardized contract. Since the contracts are standard, the future contracts listed on the stock exchange cannot be changed or modified in any possible way. In simple word, a future contract have a pre-decided size, pre-decided expiry period, pre-decided size. In a future contract, an initial margin is required because a settlement and a collateral are done daily. Second is optional contract. Option contracts are a third type of derivatives contracts in India. Option contracts are a way different the future and format contracts because these contracts do not require any compulsion or discharge to the contract on specific date. Option contracts provide the right but not the commitment to buy or sell an underlying instrument. Option contracts consist of two options, call option and put option. In call options, the buyer has all the right purchase and underlying assets at a fixed price while entering the contracts. While the input option, the buyer has all the right but not obligation to sell an underlying assets at a fixed price while entering the correct contract. However, in both call and put option or contracts, the buyer choose to settle all the contracts on or before the expiry period. This and anyone who really trades in the option contract can take any of the four different positions, short or long, either in the call or the put option. These options are traded at stock exchange and over the counter market. Third is the swap contract. Out of the three derivatives contracts, the swap contracts are one of the most complex contracts. A swap contract means the agreement is done privately between both parties. The parties who enter into a swap contract agree to exchange their cash flow in the future as per the predetermined formula. Under a swap contract, the underlying a security in the interest rate or a currency, as is a contract protect both the parties from a several major risks. The contracts are not traded to the stock exchange as the investment banker play the role of middleman between this contract. Risk and leverage. A commodity derivatives carry an inherent risk and trade often use a leverage to control a large positions with a relatively small amount of capital. While the leverage is amplified returns, it also increases the potential of significance. Market participants. The commodity derivative market has a growth in a recent year with a significant increase in the number of participants and the volume of trade. The participants in the commodity derivatives market includes a producer, consumer, speculator, and intermediate intermediators. The key participants in the commodity future market. The commodity market, speculators are there is a market for a very short period of time, and then directional margin traders, spot future arbitrageurs, a commodity price hedge. They are the participants in the market. Two important derivatives: a commodity future contract and a commodity option contract. A commodity future contract is a financial agreement between the two parties